Welcome back to The Explainer. Day 230 for the PLAZM protocol. Look, it's easy to log on every day and cheerlead the structural strengths, the vault, the burn, the yield engine, all that good stuff. But today we're flipping the script. We are taking on the role of the ultimate skeptic. We're going to build the absolute strongest bear case against PLAZM's Aave margin stack and then ruthlessly test it to see if it actually holds water. Before we get into the weeds, just a quick reminder to review the standard disclaimers you're seeing right now. We're diving into liquidation tail risks and margin strategies today, and as we all know, crypto is incredibly volatile. This is pure education, absolutely not financial advice. Do your own research, folks.
Okay, here's our roadmap for today. We'll start with the bear case setup, move into stress testing the math, test the flows and impermanent loss, compare structural versus operational risks, and finally, deliver the weekly verdict. Let's get into it.
Starting off with Section 1, the bear case setup, where we'll look at 4 potential failure modes. We are establishing a structural baseline today of roughly 323 ETH supplied to Aave, with about $250,000 in USDC borrowed against it.
Now, that brings our starting baseline health factor to exactly 2.05. And skeptics, they look at this exact setup and say, aha, there's a hidden vulnerability right there. They call it a hidden leverage stack. So let's honor that critique, shall we? Let's make their bear case as menacing as possible. To properly steelman the skeptics, we're stitching their worst nightmares into one massive, cohesive attack. Think of it as 4 failure modes. Mode 1, a liquidation cascade, where ETH crashes, dropping the health factor to 1.0. Mode 2, a sudden spike in USDC borrow rates that just cannibalizes all the vault yield. Mode 3, a catastrophic withdrawal bank run. And Mode 4, impermanent loss, completely wrecking the LP positions. Those are our 4 horsemen. Let's see if they can ride. Moving right along to Section 2, stress test, the math, focusing specifically on liquidation and rates. Testing that first failure mode reveals some pretty fascinating math. For our baseline 2.05 health factor to hit that dreaded 1.0 liquidation threshold, ETH would need to suffer a staggering 50% drawdown. We're talking a crash from around $2,186 all the way down to roughly $1,093 just to trigger a forced liquidation by Aave's keepers. That is a massive, massive haircut. To put that 50% cliff into perspective, let's look at historical reality. Over the trailing 12 months, ETH's absolute worst single-week drop was about 22%. So a 50% drop in 7 days, that's not just a bad week. That's a black swan event. Is the risk zero? No way, absolutely not. But it's definitely not the immediate cliff the Steelman argument tries to make it out to be. All right, how about failure mode 2? A brutal interest rate spike. Say Aave's USDC borrow rate unexpectedly jumps to a punitive 10%. On $250,000 borrowed, that's $25,000 in annual interest. Ouch, right? Well, wait, look at the yield engine. The current daily yield is over $680, which annualizes to roughly $249,000. The protocol's yield engine covers that punitive interest cost almost 10 times over. The math literally only breaks if borrow rates spike to the moon and the bond demand yield collapses to absolute zero at the exact same time.
Let's jump to Section 3, testing flows in MIL, where we'll look at withdrawals and market reality. Now, this beautifully illustrates why a centralized exchange-style bank run is structurally impossible here. Follow the plumbing. Bond positions are time-locked across staking cycles. You literally cannot force redeem them early. Plus, that borrowed USDC, it's sitting safely in liquidity provider positions. It's not lingering in some claimable redemption queue. So even if every liquid holder panics sold tomorrow, there's no withdrawal cascade that can force a liquidation. It just doesn't work that way.
Testing our 4th failure mode, impermanent loss or IL, we actually find a critique that survives scrutiny. Yes, the borrowed USDC and LP positions faces IL when token prices diverge. But look at the data from the last 14 days. The PLAZM to ETH trading band has been incredibly tight, so the exposure is muted right now. And remember, IL is a known cost offset by capturing swap contributions, not fees by the way, but swap contributions. It's a calculated yield drag, not a fatal solvency crisis. Bringing us to Section 4, structural versus operational risks, analyzing right and wrong claims. Let's see what the bear case gets right and what it gets completely wrong.
Here's the biggest myth out there, calling this leverage on bonds. It is simply not leverage. The borrowed USDC isn't being used to buy more bonds to aggressively multiply yield exposure. Instead, the protocol is utilizing a margin strategy to fund LP liquidity, which lets it capture those valuable swap contributions. Leverage multiplies your risk. A margin strategy for LP placement compounds your capital efficiency. It is a completely different ballgame.
Finally, Section 5, the weekly verdict, separating flaws from dependencies. Time to synthesize everything we've looked at today.
So here is the final tally for our Steelman bear case. 3 of those structural critiques, the immediate liquidation cliff, the rate spike destroying yield, and the withdrawal bank run, they entirely fail the math test. But there is one valid critique left, represented by that single slice. This system strictly requires vigilant, active operational management. A 2.05 health factor is super comfortable, but you can't just set it and forget it. The structural strength relies heavily on operational responsiveness.
Because of that operational dependency, here are the exact 3 numbers you need to track for the week ahead. First, the health factor. If you see it compress below 1.8, pay attention. Second, the USDC borrow rate. If it climbs above 8%, the cost-to-yield ratio demands your focus. And third, each 7-day realized volatility. If that breaks 80% annualized, that liquidation tail risk suddenly gets very real. Keep your eyes peeled on these 3 metrics.
As long as those 3 thresholds remain calm, the structural thesis is rock solid. The margin strategy is conservatively set up, which really leaves us with one fascinating thought to ponder. The fair criticism of this system isn't that it's structurally dangerous, it's that it isn't passive. But honestly, in a DeFi landscape built entirely on empty, passive promises, is active risk management actually a vulnerability? Or is it the ultimate structural shield?
Thanks for joining me for this structural explainer. Please take a second to review our final disclaimer regarding market volatility and the inherent risks of margin strategies. Stay curious, keep analyzing the data, and never invest more than you can afford to lose. Catch you in the next explainer.